Good morning. Today's my topic is benefits of fundamental analysis. In the previous class, I have explained about the fundamental analysis and the factors to be considered under fundamental analysis. In today's class, I am going to explain about the different benefits of fundamental analysis to an investor. How it is beneficial for investor, or what are the benefits investor is going to get from the fundamental analysis. Let me explain the first point: measurement of intrinsic value. The fundamental analysis is helps investor to measure the intrinsic value or true value. The intrinsic value or true value will help the investor to take the decision of investment. If intrinsic value is higher than the market value, then the investor can take the decision of buying of security. If intrinsic value is lesser than the market value of security, then the investor can take the decision of selling the securities. So therefore, the fundamental analysis, through the fundamental analysis, the investor is going to find out the intrinsic value or the true value of a security. And the book value related to the past only. So whenever in case of the book value of the security, it is related to the past or assessed based on the past data, whereas intrinsic value is the value which are assessed based on the present data, or comparison by comparing the present performance of a company. So therefore it plays a major role in case of the decision making process of an investor. The next advantage is intuitive appeal, is another benefits which the investor is going to get from the fundamental analysis. It enables the many factors or variables as the causal factors. It enables more factors of related to the company, and in a casual way these factors cause the benefits of the investments. This under intuitive appeal, it will consider all the factors in the casual way for the analysis, and which will affect on the benefits of the investor. Investor of even average intelligence can understand these benefits of through the intuitive appeal. Means it is reaching to each and every person. Even for the common investor, it is easy to understand the concept of fundamental analysis, or it will help the common investor also investment decision process easily. So that is called as an intuitive appeal. Next one is avoiding herd mentality. So it means there are some class of investors who act purely on the basis of market movement, which simply indicates the lack of individual conviction on the part of investors. There's some class of investors who take the decision of investment mainly based on the movements of the stock market. The market price is the resultant of the actions of various factors related to the stock market, or the movements in case of the stock market is mainly dependent on the actions or the dependence on the functions of the buyers and sellers in the stock market. The opinion of the stock market need not be a logical or acceptable one. So to avoid this complicated process of the stock market, the fundamental analysis will help the investor to make the decision of investment or a trading in case of stock market easily. So by showing the another value or the true intrinsic value, where the investor is arrived at a careful study, and the fundamental analysis makes the investor a systematic man in investment decision. So that is called as a avoiding herd mentality. Whenever there is a confusion, or whenever there is a complications in complexity or the complications in case of the decision related to the stock market based on the movements of the prices of the securities in the stock market, then it is difficult to take the decision of investment. So in such cases, the fundamental analysis will help the investor to take the decision easily with the help of intrinsic value. So that's called as avoiding herd mentality. Next one is a timing of purchasing and sale. So fundamental analysis will help the investor again when to buy and when to sell. The timing for purchase and sell. When to purchase, whenever the intrinsic value is higher than the market value, then they can take the decision of buying of the securities. So and otherwise they have to sell in opposite direction. They have to take the decision of selling of security, or they can hold it for a longer period. So that is called as a, it will helps in case of timing of purchase and sale. Next one is a total picture of business. So fundamental analysis is, it will provide, or through the fundamental analysis, investor is going to collect the entire picture of the business or of a particular company. For example, if you want to buy the securities of Infosys company, then you can collect all the details related to the Infosys company through the fundamental analysis. Again, it is no need, as an investor, it is no need to assess you personally. There are a lot of broking agencies or lot of organization who assess the Infosys company under fundamental analysis, or under fundamental under fundamental base. So through, you can refer the fundamental concept of the Infosys, then you can take the decision of investment, or you can even you can get the intrinsic, you will get the intrinsic value of Infosys, and then you can take the decision of buying and selling of security. So then fundamental analysis will provide the entire picture of the business of a particular company. What about the present scenario, and what about their future plan, and the each and a present scenario and the past performance, each and every data of of a particular company is going to be collected through the fundamental analysis. Next one is using real-time information. The fundamental analysis will get the genuine information or real-time information, real data to analyze a particular company. So that's called as a, it use the real-time information, genuine data, real data. So through that you can believe on the fundamental analysis. Next is a qualitative approach. The fundamental analysis is a qualitative approach because it is purely based on the data related to the particular company. So you can believe it because it is an in-depth study of the performance of a particular company. They are not dependent on one particular factor. All the factors related to the company are collected under fundamental analysis. Then they will assess, or then they will evaluate the intrinsic value or true value of a particular security. The next one is a more acceptability. More acceptability means almost all the investors, either day trader or a long-term investor, or in case of derivatives, derivative investors, each and every trader in the stock market, or each and every investors, generally they accept fundamental analysis. Even the technical analyst, or the person who or the investor who trade in the stock market, they also trade on the basis of fundamental analysis of the particular company. So means it is the most reliable one, because it is assessment based on the data, genuine data, or based on the real-time data of the particular company. So therefore it is more acceptability. Sorry. So that is called as a more acceptability. Everyone accept the fundamental analysis. Next one is a long-term investment. See, generally fundamental analysis will help the investor or the person who takes the decision of investment for a long term. If you want to invest, or if you want to borrow a particular security of a particular company for a long term period, then it is better to take the decision based on the fundamental analysis. So therefore the fundamental analysis will help for the long term investment. Next is value investment. Whenever an investor takes the decision based on the fundamental analysis, then it is called as a value investment, because you are going to take the decision of investment after considering or after studying each and every factors related to the company. Again, it is no need to study personally. There are a lot of agencies, broking agencies or rating agencies, or a lot of brokers in the stock market, related to the stock market. They will provide the information, or directly you personally search the information related to the company as per the fundamental. So you can type the fundamental analysis of Infosys company or Reliance company or so and so other company in the Google, then you will get lot of details related to the fundamental analysis. No need to pay any charges to any person. So if you take the decision based on the fundamental analysis, then your investment decision is called as a value investment. So these are the benefits of fundamental analysis. Next, drawbacks or the demerits of fundamental analysis. The first one is data intensive analysis. The fundamental analysis is called as a data intensive analysis, means it is purely based on the data which are collected from the company. It says that why it is a data intensive, there may be the possibility of manipulation of data by the company. We generally collect the data from the company itself, the information to be provided by the company. So then whenever, if the company provides the genuine data, then we will, our assessment is correct, our decision is correct, we will get the right true value or intrinsic value. If the company provides manipulated data itself or fake data itself, then our assessment or our decision generally will be wrong. So that is a data intensive analysis. So that is a one drawback. And next one, involving time and energy, is another drawback. Why? Involvement of time and energy to assess. So you have to analyze, you have to study each and every factors of the company. So it requires more time, and as well as it requires more skill. Energy means here the skill, you need more knowledge. Even after studying the investment concept, then also we have the lot of doubt regarding intrinsic value or the market value, how or true value, how it will play in case of stock markets. So it requires more skill to study the concept related to the fundamental analysis. So therefore, involving time and energy, you have to collect the data, then you have to study, then you have to fix the value, then you have to take the decision of investment. At that time, the market may reverse or the company's performance may change. So that is called as a involving time and energy. Next one is a source of information. The source of information which are collected related to the fundamental analysis, so one is a company, or even if you are collected through the external sources, then whether it is a genuine source or not, same like data intensive analysis. We have to collect the data either from the company or from the other sources. Some sources, some information we have to collect from the company itself, and some information we can collect from the external sources. But whether that source of information which we whether it is a genuine or not, so that's again there is a possibility of manipulation of data. So that's a demerits of fundamental analysis. So after studying these concepts, so you can take the decision of investment based on the fundamental analysis, especially for the long term period, and it is a value investment. Benefits are more than the drawbacks. So that's all about the fundamental analysis. The next concept of today's class is technical analysis. The another analysis of investment is technical analysis. There are two analyses under investment. One is a fundamental analysis and another is a technical analysis. So till now I have explained about the fundamental analysis. The fundamental analysis is generally followed by the value based investors, where the investors take the decision of investment based on the intrinsic value or the true value of an equity share. And now the secondary part, or the second investment analysis, that is a technical analysis. Technical analysis is a security analysis methodology for forecasting the direction of prices through the study of past market data or primarily price and volume. So here under technical analysis, it is the analysis, or with the help of technical analysis, the investor is going to take the decision of investment based on the movement of prices of a security in the stock market, or it is under technical analysis, the investor is going to study about the movement of prices of a security in the stock market in the past, and on the basis of that, then they will take the decision of investment. Mainly here, the decision is based on the movement of the prices of a security in the stock market and the volume of trade in the stock market. So that is called as a technical analysis. It is purely based on the movement of prices of the security in the stock market. Technical analysis is a term used for predicting the direction of prices of a stock market through the study of past market data, primarily price and volume. The same concept again, it is a prediction of the movement of prices or direction of prices of stock through direction of the prices of a stock through the study of past market data, or through the study of performance of the security in the past in the stock market. So primarily based on the price and volume of a security in the stock market. In total, technical analysis is the study of the movement of prices of a security in the stock market in the past, and on the basis of that, they take the decision of investment. Means it depends on how the security performed in the previous day, in the last week, or in the last month. So on the basis of that, they take the decision of investment in today. So that is the current decision is based on the past performance, yesterday's performance in the stock market. So it is, there is no other assessment. It is for generally this technical analysis method followed by the day trader, the investor who trade daily in the stock market. So as per Richard W. Taylor, technical analysis means the technical analyst believes that important information about the future price movement can be obtained by studying the historical price movements of stock prices. The financial data are recorded on charts and scrutinizes in search of repetitive patterns. The technical analysts base their and sell decisions on the charts they prepare. So here under technical analysis, the investment is purely based on, the analysis is purely based on the chart, means the based on the past data, so historical price movement. And they consider, they assume that technical analysts, they assume that that historical movement of a particular price, they are going to repeat again in the future in the stock market. So it is a prediction, the probability, it may occur or it may not occur, so that dependent on the future. But generally they collect all the historical price movements of a particular security in the stock market, then they will assume that yes, this particular pattern or this particular movement is going to occur again in the stock market. So that is the movement, the previous movement, price movement of a security will be recorded on the chart, then they will analyze it, then they assume that that is going to repeat in the future, repetitive pattern that occurs again, like in case of business cycle, boom period and recession period. Here also there is a bull trend and bear trend in the stock market. They assume that if there is a bull trend, definitely there, and some after some time bear trend will occur, and again after bear trend again bull trend will occur. So then that is when it will occur, that analysis is based on the past data. So that is about technical analysis. It is purely based on the movement or behavior of a price of a particular stock in the stock market, and on the basis of that, then they will take the decision of investing in the or trading in case of stock market. Next, assumptions of technical analysis. The first one, the market discounts everything. The technical analyst or the investor under technical analysis, they believe that the market discounts everything. For example, if there is a downfall in case of the price of security today, then they assume that it consider the lot of factors, internal and external factors. So therefore, because of influence of some factors, the price has been reduced today, and today price of security fall down due to some factors. So means market discounts everything, not only company factors, internal factors, but also external factors. Even if there is a uptrend in case of movement of price of a security, increase in case of movement of price of a security, then it assumes that there is a it consider all the factors, internal as well as external factor. There is some factors influenced on the market. So means market discounts everything, means market consider all the factors, then it moves. So therefore they believe on that particular strategy. So that is called as a market discounts everything. Even if there is a changes in the government, then the sometime price of the security may up or down, fall or increase, that dependent on that particular movement. Behavior may be in any side. So that is behavior is dependent on the, by considering all the factors, because it may be internal factors or external factors. So but it consider every factors. Next, price moves in trend. Generally they believe that believes that, or assumption that, price moves in trend in the stock market. Trend means up, bull trend or bad trend. If there is a bull trend in the stock market, then they assume that in same direction even the prices of the security will also move. And if there is a bad trend in the stock market, then they assume that the prices of the security fall down because due to bad trend. Definitely, but not all the security, but most of the movement of prices of the security is generally dependent on the trend in the stock market. So therefore the price moves in a trend, and it sometime it's applicable, sometime it may not applicable because of some internal or external factors. This technical analysis is purely based on the probability. So it is you must have in-depth knowledge. Even you sometime it influence fundamental analysis also, but it is not considered as a scientific method of analysis. Technical analysis is not a scientific way of investment, whereas fundamental analysis is a scientific way of investment, because there you are going to analyze each and every factors. But here it is not each and every factors is not analyzed, but they assume that the market consider, or the stock price, behavior of the stock price is dependent on, after considering all the factors related to that particular company. Next assumption, history tends to repeat itself. They assume that under technical analysis, history tends to repeat itself. Means if whatever occurred in the past, that's going to occur again in the future. So that is their assumption, and they believe on that. If there is a bull trend today, and that is going to occur again in the future, so that bull trend will occur again in the future. So that is, or if there was a bad trend in the stock market earlier, then they assume that it's going to repeat again in the future. So that is called as a history tends to repeat itself. Means it will not move directly one side, and it will not downfall directly. There will be ups and downs in case of behavior of the stock market. Definitely there is a changes or movement in case of stock market. Ups and downs are there in the stock market, and it dependent on the past data, and that's why they says that that is going to repeat again and again. If you observe the charts of the stock market, then it is easy to understand. Say in the here this movement, see the movement, these movements, this is going to occur again and again, ups and down, ups and down, ups and down. That is means if here it's a down, and again it's ups, and again down, again ups, and again down. So that means see this one and this, and again this occurred the same level. So that's what they believe, the history going to repeat again and again. So this same, it has been reduced, price has been reduced to same level. So that is called as a history going to repeat again and again. Till that they will wait, and then they will take the decision of investment. Next one is a technical analysis is called as art over science. Why it is called as art? It is a skill. You need skill. You need additional skill to take the decision of investment through the technical analysis. It is not scientific way of investment. There are a lot of theories related to the technical analysis, but they are not guaranteed. They says only the probability what is going to occur or how the behavior will be in the future, that will be said by the in the particular through the different theories of technical analysis. The theories of technical analysis says only how the behavior may be in the future, but it is not guaranteed. There is no certainty as per the technical analysis. So therefore it is called as art over science. You need extra skill, additional skill. It is a skill or idea or strategies which are not dependent on any particular theory. So therefore it is called as art over science. So you have to study in depth. If you want to get knowledge, if you want to study the behavior of the prices of the security in the stock market, then you must have the enough knowledge about the stock market. And momentum reverses, the trend is going to reverse again. So that is the assumption. So means history going to repeat again. Momentum reverses, bull trend, uptrend, bad trend, again bull trend, bad trend, and so that is called as a momentum reversal. So these are the assumptions of technical analysis. There are a lot of tools or theories to technical analysis that I will explain in the next class. Thank you very much.